How's it going, everyone? And welcome back to the channel. So in today's video, we'll be talking about 3 trading strategies in investing and going over each and every one of their fundamentals, what they're all about, and which of the 3 strategies are the best. So the strategies that I'd like to talk about are the 3: swing trading, day trading, and scalping. So starting off with swing trading. So this strategy involves holding positions for multiple days to weeks, aiming to capture short-term to medium-term price movements. Swing traders typically analyze technical indicators and chart patterns to identify potential entry and exit points. So swing trading is all about positioning yourself and knowing when the value of a stock may raise in price. So swing traders often seek to capitalize on price swings with an established trend, aiming for larger gains compared to day traders or scalpers. However, holding positions overnight exposes swing traders to overnight risks, such as gap openings due to unforeseen market events. So there's definitely some risk involved when it comes to swing trading. However, it is still a viable option. So moving on to the next, which is day trading. So day trading pertains to the idea of where traders open and close positions within the same day trading stocks. So the idea here is they actually aim to profit from an intraday price movement or price movements of certain stocks and investing. So day traders closely monitor the market trends, news events, and technical indicators, executing multiple trades throughout the day. So they don't actually wait to see when the stocks are going to go up or down the next day. Instead, they're all going to trade within that 24-hour window. So day trading requires a lot of discipline, focus, quick decision-making skills, and as traders, they must react swiftly to adapting to the changing market conditions. So while day traders avoid overnight risks, they face challenges such as high trading costs and the pressure of making split-second trading decisions. And lastly, let's talk about scalping. So scalping is a strategy focused on profiting from small price movements over a short time frame period. So oftentimes, this can happen within seconds to minutes of trading. So scalpers aim to execute numerous trades throughout the day by capitalizing on small price discrepancies and liquidity imbalances. So what this means is that scalping requires precision, speed, and advanced trading tools such as direct market access or DMAs and an algorithmic trading software that they could use in their favor. So while scalpers aim for quick profits, they must also contend with high frequency trading or HFT algorithms and tight bid-ask spreads. So if you ask me at the end of the day, which of these 3 is the better option, I would have to go for scalping, as scalping has the least amount of risk when it comes to trading, and it's definitely an entry-level method to investing. So hopefully this video helped you guys out, and if it did, be sure to let us know down in the comment section below, and thank you all for watching. Bye-bye.